You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Matt Fisser.
We'll begin with the new standard released with the IASB last month. IFRS 18, Presentation and Disclosure of Financial Statements, introduced new reporting requirements in order to provide investors with a better basis to analyze and compare companies. Most drastically, there are now defined categories for income and expenses on the income statement, and companies will be required to calculate new defined subtotals, including operating profit, in the same way. Previously, there were no specified structure or defined calculations on subtotals.
Additionally, IFRS 18 will now require companies to disclose more information on companies' specific measurements related to the income statement, with the intent to allow investors to understand how these management-defined performance measures are calculated. Finally, the new standard has provided additional guidance on how to group information and whether to present them in the financial statements or disclose them in the footnotes, as well as requiring more transparency on operating expenses. The effective date of IFRS 18 is on or after January 1st, 2027, although early adoption is permitted.
Yeah, and if you've been listening to us for a while or have been following along with the European Parliament and their decision around the Corporate Sustainability Due Diligence Directive, or CSDDD, the roller coaster ride has come to an end. The CSDDD has finally been voted into adoption and will become law, which is expected to happen in the first half of this year. This will apply to European Union and non-European Union companies, including many US-based companies with activities in the EU that meet certain thresholds. The directive creates new obligations for human rights, environmental due diligence, a climate transition plan, and due diligence processes, together with other specific due diligence obligations under other regulations that protect human rights and the environment that were also approved by the European Parliament. Companies that are in scope, and even those that may not be in scope directly, but are within the chain of activity of those that are in scope, will feel the effects of this new obligation.
The directive is expected to be published in the official journal of the EU sometime in the first half of this year. There will be a gradual implementation applying to larger companies first. The EU will require companies that meet the threshold to begin applying the obligations in 2027. Although the EU is expected to put the directive into force this year, the EU member states in the European Council will have an additional 2 years to implement the directive into their respective national law.
And in other sustainability news, the IFRS Foundation and the European Financial Reporting Advisory Group, or EFRAG, released a guide to help companies navigate the new sustainability requirements released by each of these standard-setting organizations. As you might recall, both of these groups released frameworks for sustainability reporting. While they share similar goals in enhancing the consistency and comparability of sustainability reporting, there are differences in their approaches and requirements. This jointly issued guide helps highlight these similarities and addresses the differences to assist companies looking to follow both sets of guidelines.
We will wrap up today with a quick look at what the FASB Private Company Council has been up to. The council met last month to discuss the status of the FASB's current projects. Notably, the council discussed the board's decision to pursue improvements to ASC 350/40 internal use software and provided feedback on the applicability to private companies. This feedback will be considered when voting on proposed private company alternatives, which must be approved by 2/3 of the council members in order to be recommended to the board. The council also discussed the board's decision to improve the accounting for government grants by leveraging IAS 20. PCC members asked clarifying questions and generally expressed support for the proposed changes.
And that rounds us out quickly for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcasts on the Accounting Matters feed on your preferred listening platform. Also, to stay ahead of the curve on climate reporting, join Embark's ESG specialists in our on-demand webinar about the latest SEC climate disclosure rules. Our team provides critical insights to lead your company forward on their sustainability reporting journey. A link to the webinar is included in our show notes. Again, I'm Adam Olsen.
And I'm Matt Fisser.
From your friends at Embark, thanks for listening to AM Now. Stay happy, and we'll see you next week.